Hey folks, Dan Frio here with your closing bell for January 29th, 2025. So it was Fed Day. Fed Day today, and what did they do? They didn't really do much of anything today, guys. So that's what we're going to go over today in today's news. Right through here, Federal Reserve comes out and actually does nothing. They just kind of kick the can once again. We kind of expected that. And here's the reason why. And I'll go over the reasons why and why Federal Chairman Powell said, well, the economy looks in pretty good shape from our point of view. And then we're going to get over to instant market reactions in the bond market, the equity markets, and then what does the future hold for future rate cuts? So that's what we're going to talk about in today's video. So my name is Dan Frio. I do this video every day. If you're out there looking for a mortgage to maybe buy that first house, maybe first investment property, maybe even looking to refinance. We have a lot of clients that bought in the 8s. Now you have rates kind of in the 6s. It might be a good time to do that. So I'll give you all my information at the end of this video because I hold a license all through the whole country and I'm set up with over 30 different lenders. So we'll talk about that in a minute. But right through here, here's the reaction what mortgage rates did today. I'll show you the chart here in a second. They really didn't budge at all. So let's get to the news that we have right through here. Cautious Fed holds rates steady with Trump's unknown looming over the outlook. So what they're concerned about is, like we continue to say every day, we have tariffs hitting the markets, and then we have the unemployment numbers and employment numbers and everything else. And then we also have inflation that they really want at 2% that's not getting there. And that's why they're saying we're just going to hold off for now and let the dust settle on a lot of these things that are just up in the air right now. So here's what they're looking at. So basically, this is the economy at a glance. So the Federal Reserve, well, they control that rate right over there. It's the federal funds rate. 4.25 to 4.5 is what that rate is right now. But here's what they're looking at. They're saying, okay, the PCE, that's the inflation gauge that we monitor the most. It's at 2.4. We want this at 2%. So we're going to keep doing what we need to do to get it down to 2%. Unemployment rate's still fine. We thought this would go to 5%, and it's holding steady down in the 4s, so no concern over there. And then right over my head, we have GDP, how robust the economy is growing. It's growing at a tune of 3%, and that's really good as well. So overall, the economy is looking pretty good. So right through here, here's what the reaction to the bond market was today. Bonds opened up. They were basically flat. And then the news came out, and you saw we had some deterioration throughout the day. And then right when they announced what they were going to do, the markets just plunged. And we locked a lot of people right in through here because I just from the verbiage of some things and everything else, I didn't think this was going to go very well. We're also looking at cautious because there's some news coming out tomorrow and Friday that will be market movers. So let's get over to see how the equity markets fared today. Everything's in the red and the VIX is in the green, all the opposite from what we want. This means all the equity markets are down right now, and the VIX that measures let's say the anticipation on Wall Street, it's up a little bit today. On the oil front, we had oil down just a little bit. We still need to get this down to $70 a barrel. But let's get over to what the Federal Reserve, the chairman said today. Let's get to a small snippet of what he was saying about some questions in regards to tariffs, what their expectations on future rate cuts. Let's get over to what Chairman Powell has to say, and then I'll give you my take on this as soon as he finishes.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
So that's his take. He's saying the economy doesn't need a boost of lower interest rates at this time. So based on a lot of the data he's saying, he's on point. The problem that arises is the people that are put in the most worst position with a lot of these policies are people on the lower end of the income scale, and that's when it's really tough. So you have a lot of people in the middle and upper levels that have they don't have as much debt because that debt load that people are carrying right now. If you check your credit cards, don't be surprised if that credit card debt you're carrying is about 28% on interest rates. So you'll never pay those things off. So if you have some equity in your house, you might want to look at doing something with that. So if you go over to here's how the equity markets, like I said, fared for today. But here's what the data that's coming out in the next 2 days. Now, this is real important because if you go over to the federal funds, the economy at a glance, the Federal Reserve was put in place for two things, and it's called two mandates. One was price stability, which is aka inflation, and the other one is full employment. So if we go over to this category here, they're looking for future data. Well, on Thursday, we're getting initial jobless claims. So that's going to give us a bead on the employment numbers. And then on Friday, the PCE, this thing is popping its ugly head up right now. And again, the PCE is the number one. I'll go right over to here. PCE, this is what the Federal Reserve puts the most weight in. So that number is coming out on a year-over-year basis on Friday, as expected. Well, the last reading was 2.8, so we're hoping this comes down to 2.7, 6, 5, or 4. If you get a 2.9 handle or above, the markets are going to get clobbered. We're also looking at the PCE month over month, possibly to start coming back down in line with that. So we'll be posting tomorrow on the initial jobless claims, and GDP's coming out. It's expected to go from 3.1 to 2.7. We'll see how that goes, because the more robust the GDP, that could outrun our national deficit, and that's a big help there if the GDP can continue to run. So that's what we're seeing in the markets right now. So there wasn't really any shock and all at first when they announced their policy. The market did have a hiccup, but it came back and rallied. But like I said, there's a lot of news coming out in the next 2 days, and if anything is a little bit bad, you're going to see rates spike fast. So good news, I don't think rates are going to plummet. They might drop a little bit, but the bad news is that's what we're concerned about at this point. So be careful what you're doing out there. If you need some help, so you're watching my videos and you're like, Dan, okay, I learned a lot. What do you really do? Well, I'm actually a mortgage loan officer. So I work at ServBank. ServBank's the number 10 largest servicer in the country, so it gives me a license all over the country. The unique thing about ServBank is we're also a brokerage. I'm set up with over 30 different lenders, and my slogan is one application, one credit pool, and I'm going to shop your loan to over 30 different lenders. Where else can you do that on your own? So if you can do that on your own, God bless you. But we'd like to partner with you basically from application to keys in your hand, and that's what we're here for. So visit us at therateupdate.com. You can put in your application right there at the top. We would love for you to schedule a consultation, a one-on-one, so you can ask all your questions. You can actually vet us. Ask us any question that you have. Make sure we're knowledgeable enough to win your business. If you'd rather just call us, well, you can scroll down right over here. Give us a phone call right down through the bottom. And our number is 844-775-5626. Or you can reach me personally at dan@therateupdate.com. And please, if you have any questions, don't leave them down there in the description. Just leave comments down below. If you really have a question for me, shoot me an email. I'd be more than happy to answer it. If you add your phone number in, I'd be more than happy to call you as well. Thanks for watching, folks. God bless. Have a fantastic evening, and I'll see you back here tomorrow.